The stock market is currently closed, and Opendoor Technologies, Inc. finished its last trading session on Friday, October 17, 2025, at a closing price of $7.16 per share, representing a modest increase of plus 0.70% for the day. While that closing price might seem like a small, uneventful tick on the chart, the real story here is not Friday's slight uptick, but the sheer, breathtaking volatility and speculative frenzy that has propelled Open from a 52-week low of about 51 cents to flirting with $7.16, a run of over 1,300% in a little under a year, demonstrating a level of retail-driven momentum completely detached from traditional analyst expectations. The common wisdom on Opendoor is that it is a hyper-volatile, eye-buying stock, a proxy for the housing market, and a business that has struggled with consistent profitability, often viewed as a speculative bet by retail traders who see it as a turnaround story. This perspective is accurate on the surface, but it misses the core factor now driving the stock: a profound internal operational and leadership overhaul that signals a very real and very expensive attempt to fundamentally change what the company is. The internal reality of Opendoor, which the market has arguably not fully priced in yet, centers on two critical recent developments: a significant leadership shakeup and a multi-million-dollar cash injection from insiders and founders. In September 2025, the company appointed a new chief executive officer with a strong background in technology and scaling platform businesses, an AI-native executive, as they've been described. Alongside this, the co-founders have not only returned to the board of directors, but have also committed to $40 million in new equity financing through a private placement. This isn't just a corporate reshuffle, it's a capital-backed declaration that the original founding vision, which relied on rapid capital-intensive scale, is being aggressively merged with a new, cost-conscious, data-driven operational mandate. The expectation is that Opendoor is merely cycling up and down with housing prices. The reality is that the most recent surge has been supported by a tangible structural commitment to using artificial intelligence and data science to improve pricing accuracy, manage inventory risk more effectively, and cut operational waste. A tacit acknowledgement that the old iBuying model, as the company practiced it, was deeply flawed in volatile markets. We need to address the immediate price action and trading dynamics because this is where the tension between retail hope and institutional skepticism plays out. The stock's dramatic run is clearly visible, surging approximately 944.9% over the past 3 months, a performance that wildly outpaces the broader S&P 500. This kind of explosive upward movement is not fueled by small, slow institutional buying. It is characteristic of retail enthusiasm and a strong short squeeze dynamic. The short interest in Open is still remarkably high, with over 150 million shares sold short as of the most recent settlement date, representing over 21% of the total float. This massive short position provides the structural foundation for the stock's volatility. Every time there is a glimmer of good news, like the management changes or the recent history of earnings per share beats, even if the company is still reporting losses, it forces shorts to cover, creating powerful, short-lived upward surges that draw in more speculative traders. The high trading volume, which has seen some days exceed 77 million shares, further underscores the intense speculative interest. This high short interest and retail momentum is the primary engine behind the price swings, not quarterly home sales data. Now, let's look at the actual institutional sentiment, which provides a stark contrast to the retail exuberance. While the stock has seen massive gains, major institutional holders have recently been net sellers. The latest filings show that 161 institutions decreased their positions in the most recent quarter, collectively liquidating over 135 million shares, including significant reductions from major names like BlackRock and Vanguard Group. Conversely, 107 institutions did increase positions, and some, like 2 Sigma and Cube Research, established large new positions, suggesting a split view. However, the net outflow of institutional capital from the biggest established funds is a serious countersignal to the retail-driven price momentum. The narrative that institutional investors are simply pouring into the stock to capture the turnaround is challenged by the significant scale of the selling activity from some of the largest shareholders. Moreover, professional analyst coverage remains overwhelmingly cautious, with a consensus leaning toward hold, and some major banks issuing sell ratings with median price targets hovering around the $1.14 to $1.60 range. This means that at the current price of $7.16, the stock is trading at a significant premium to what the majority of professional analysts consider to be its fair value, creating a monumental disconnect between market price and expert opinion. To appreciate the full context of this company's operational pressures, we need a brief reminder of its business model. Opendoor is the leader in the iBuying sector, a data-driven approach to instant home purchasing. The company uses its proprietary technology and data to make quick, non-contingent cash offers to homeowners, bypassing the traditional real estate process. After purchase, Opendoor makes light repairs and lists the home for sale. The goal is to generate profit from the home sale and ancillary services like title and mortgage. It's a high-volume, low-margin business that requires enormous access to debt financing, which is why interest rates are such a huge factor. The company's historical performance has been a textbook example of a growth-at-all-costs model running headlong into macroeconomic headwinds. In 2024, revenue saw a steep decline, falling by 26% year-over-year to approximately $5.15 billion, primarily due to lower sales volumes as high mortgage rates crippled the residential real estate market. While they did manage to improve their gross margin to 8.4% and cut the loss from operations by 17%, the net loss still increased to a significant negative $392 million for the fiscal year. This financial reality, multi-hundred million dollar annual losses, is the hard truth that counters the stock's volatile excitement. The market may be betting on future profits, but the current financial statements show substantial cash burn. Looking ahead, the tension is entirely focused on whether the new management can execute on the AI-powered platform strategy to deliver better, more predictable unit economics. The next major test will be the third quarter 2025 earnings report, which is expected to be released in early November. The consensus EPS forecast is a loss of around negative 0.08 per share, which if achieved would be an improvement over the negative 0.13 loss from the same quarter last year. The recent second quarter report showed a revenue beat, but the forward guidance for Q3 revenue was significantly below analyst expectations, which caused the stock to slump by around 14% immediately after the August release. This is the crucial pattern. The company reports better past performance than expected, but its future outlook dampens enthusiasm. This tells us that the market is still deeply skeptical about the near-term ability of Opendoor to regain its rapid growth trajectory in a higher-for-longer interest rate environment. The core catalyst for a sustainable stock price rise would be 2 consecutive quarters of strong gross margin improvement coupled with revenue guidance that actually beats expectations. The newly appointed CEO is pushing a narrative of shifting to a more durable, software-driven, capital-light platform, potentially expanding offerings that don't require Opendoor to hold as much risky inventory on its balance sheet. If they can show demonstrable progress on this transition, meaning a significant reduction in financial exposure to home price volatility, the market will re-rate the stock, as the business model risk will have been fundamentally reduced. The downside risk remains substantial, dominated by the continuing high interest rate environment which slows down housing transactions and the inherent volatility of a stock with such a large short interest. Any macro surprise or poor execution on the new strategy could trigger a massive short seller attack and a rapid decline back toward analyst price targets in the low dollar range. The difference between the stock's current price and the average analyst target is an astonishing disconnect, making Opendoor one of the most polarizing and risk-concentrated stocks in the market today. Investors must weigh the momentum-driven exuberance of the past year against the cold, hard numbers of the quarterly financial losses and the cautious stance of major institutions. Before you make any moves on this name, comment below how many shares of Opendoor Technologies Inc. you currently hold and what price you believe the stock will be at by the end of the next earnings call. In summary, the expectation for Opendoor Technologies Inc. is that it is a roller coaster real estate stock driven purely by the ebb and flow of the macro housing market. The deeper reality is a company in the middle of a drastic, expensive restructuring, attempting to replace its core, flawed, capital-intensive unit with an AI-driven, risk-mitigated platform, all while facing a massive short position that fuels extreme price swings. The recent closing price of $7.16 is more a reflection of speculative momentum and short covering pressure than a solid endorsement of current financial health. The true test of this stock's viability lies in its ability to translate the new leadership's technological vision into consistent, profitable unit economics over the next 12 to 18 months, a fundamental challenge that the company has historically failed to meet, leaving a vast speculative gap between the stock price and the underlying business fundamentals. This contrast between the dramatic 1,300% price surge and the negative multi-hundred-million-dollar bottom line is the central dynamic you need to understand to navigate this investment.